Well, the minutes show a united open market committee. The labor market had remained tight, but job gains had moderated, as had inflation, and that justified leaving rates unchanged at that November 1st meeting. Quote, all participants agreed that the committee was in a position to proceed carefully, the minutes say. Further tightening would be appropriate if progress toward their 2% inflation goal was insufficient, but in the meantime, all participants judged it would be appropriate for policy to remain at a restrictive stance for some time until inflation is clearly moving down substantially. Policymakers took note of the tightening in financial conditions, from market rates moving up substantially, their word, in the weeks before their meeting. Many suggested the move was driven primarily or substantially by a rise in the term premium on Treasury securities. And generally, they also felt a greater supply of Treasury securities contributed to the increase. However, quote, they also noted that whatever the source of the rise in longer-term yields, persistent changes in financial conditions could have implications for the path of monetary policy. Many noted it was uncertain whether the tightening would persist, however, and to what extent it reflected expectations for tighter policy. That helped make the economic outlook particularly uncertain. A strong economy might make inflation stickier. A potential broadening of the Middle East conflict might affect oil prices. Commercial real estate valuations might adversely affect some banks, and most continue to see upside risks to inflation and downside risks to growth. Leaving rates unchanged, they said, would give Fed officials more time to evaluate economic developments.
Well, Mike, we think about what's happened in the week since that meeting, and obviously we've seen a huge rally in the stock market, but also in the bond market, bringing those yields down, loosening those financial conditions that those Fed members actually pointed to. And with these headlines in mind, these minutes from the Fed, how does some of this pricing for rate cuts next year stack up?
It doesn't really give us any indication of what they're thinking about that. They did emphasize the need to keep rates higher for longer. They took into consideration where rates had gone and the possible tightening of financial conditions from that, but made it clear they weren't sure that that would continue. And of course, it did not. So it doesn't seem to be a major factor in their continuing ongoing outlook.